everyone can say doom and gloom, and there are some things that are doomy and gloomy. And then people say, well, what are the solutions? Well, the solution essentially is to decentralize yourself from a lot of things, systems and structures that are resetting or collapsing, regardless of what term you want to use. So a big question mark in the economy, and what a lot of people talk about, obviously, is what's going on in the markets? What's going on in the economy? How safe is my money in XYZ institution? You know, how safe is my money here or there? So what's the solution to all of this? Decentralization. And decentralization, for example, let me just use food for an example. A lot of people have shared in our community some information about supply chain disruptions. So there's a lot of folks looking at this going, saying, wow, there's some issues in the food supply, just prepare accordingly. So what can you do? You can decentralize yourself from a system if there is a gap where there might be things not on the grocery shelf that there's usually. Well, you have an emergency food supply. You grow your own food. You have your own water somewhere. So it's not that the world's coming to an end. It's just decentralizing yourself. And if nothing happens, you still have some food. You're still growing healthy, delicious, nutritious food that you're eating. And you still have some drinking water. So that's what I mean by decentralization. And this is where infinite banking comes in, because essentially we have a framework that we share in which we all operate, as folks in the economy. So we make our money one way or another, right? And we can look at the cash flow quadrant, how people make their money. It's either as an employee, self-employed, a business owner, as an investor. So we make our money somehow. Then we have to put our money somewhere. It has to reside somewhere. Even if it's under your mattress or in a tin can in your backyard, it still has to sit somewhere. And then we deploy our money is the next step somewhere. We deploy our money into other assets that produces more money through investing and through real estate investing. And then, of course, there's another pillar which we talk about protecting what we produce and create, making money, protecting where we position capital, and then protecting the assets which we invest in. So how do we protect things? Well, tax strategy is a very good one, and a focus, or should be the focus of every person right now, because there's going to be a lot of things changing from a tax perspective. Proper estate planning, proper asset protection, those are all protecting sort of that wall around your kingdom that you're trying to build as a producer and a creator. So where does infinite banking and this concept of self-reliance fit in is where you position the capital. And essentially, we look at different places that we could put money. We could put it in a bank, we could put it in an IRA, we could put it in a qualified plan and so forth, or the vehicle that we use and choose as a dividend-paying whole life insurance policy with a mutual insurance company structured specifically for cash value, for high cash value. Some folks have called it high cash value life insurance. There's many different names that this vehicle is described, but essentially what it is, it's a policy with a mutual insurance company, a policy which is designed specifically for cash value. So you would have 70% or more of the premiums put into that policy available as cash within the first year. So this is not the policy that Dave Ramsey and Susie Orman hates. For some folks that would already say, well, but Dave says this and Susie says this is something completely different. So there's many ways to buy things. You could buy things retail, you could buy it wholesale, or like the pros buy it. This is how family offices structure and where they warehouse their capital to. So that's what we prefer. And we prefer it as opposed to the IRA, the qualified plans, and the bank, because you have more control over it. You have use over it, and the liquidity is available for you to invest in real estate, to invest in other areas. Where if you put money in a qualified plan, can't take it out. Yes, maybe you can get a loan for a little bit of it, but essentially you're playing in the government sandbox. So you have to obey by the rules of the government sandbox. This is you creating your own sandbox, kind of decentralizing it, creating your own little pool of money that's in a mutual insurance company that's not listed on the stock exchanges like other insurance companies. So they manage their company on behalf of the shareholders, which is the policyholders. So, which is you. So a lot of folks would say, well, what about AIG? Stock company, they're probably going to be in trouble again with the next crisis. You want it with a mutual insurance company, companies that have been around hundreds of years. since the mid 1800s. Some of them have been around. Just think about that for a second. How many companies can you name listed on the stock exchanges that's been around for 100 years?
And I think that's important for our viewers to know too, is the difference between, the fact that it is not publicly traded. So, you are not beholden to someone that is necessarily or potentially out, for their own bottom line or for the, overall bottom line of the business. But in this instance, they're actually specifically have your interest in mind. Is that correct?
That's correct. So what they do is, because you're the shareholder of the company, the policyholders, so they're managing it on behalf of you. So they don't have to take any risks to do quarterly reports of earnings for their stockholders to get more people to buy their stocks. So because they're outside of that Wall Street casino, they can do things that are proper and what should be done, and manage their company accordingly, which is a huge difference and a difference between the two worlds. So that's why I say you decentralize things, because you're now out of the casino system. You're dealing with folks that manage risk very, very well. You have their money in a place that would have survived every single major market crash, the Great Depression, the last massive financial crisis. These companies literally didn't bat an eyelid. They just kept on going, and some of them even maintained their dividend scale, which is sort of a profit sharing for you. So this is why you have it there. The other reasons why we really like it is the money that's inside there, the principal is protected. So $100,000 in there is protected. It's not going down in value. If there's a stock crash, that 100,000 is still in there. It's not affected by that. The growth inside of those vehicles is guaranteed at a certain rate. It's tax-free. There's dividends paid, which is profit sharing. It's not guaranteed, but these companies, the one carrier has been paying it since 1847, every single year consecutively. It's kind of crazy. So you've got that going on. You can, the death benefit is tax-free to your beneficiaries. So it ties into the estate planning and asset protection planning. It plays into as well, because a lot of this money in most states, you have to do your own due diligence, but in most states, the state that I live in, the cash value in that policy is protected from any lawsuits and so forth. The great part about also that vehicle is you can access the money in there, and it's not taxed as you access it, because you do it through a policy loan by collateralizing the cash value. And that just means that you place your cash value up for collateral and you get a loan against it. So if you have $100,000, let's just say in cash value in your policy, and you get a loan for $90,000, which most of these carriers will give you a loan up to 90% of your cash value, you get a policy loan for that 90. That 90, number one, is not taxed because it's a policy loan. And then number two, that 100 is still in there growing because you never touched the original amount. So your money is doing double duty. Capital maximization is what we call it. It's doing different things for you at different times. And it allows you to use where you position your capital to set up a nice pool of money and capital, an asset, and then leverage that to go and acquire another asset, such as real estate. And eventually you have two of them, two assets with the one pool of money. So that's why we really like this, because essentially it helps you to become your own bank. So Nelson Nash wrote Becoming Your Own Banker. Nelson was a mentor of mine, great man. He shared this whole concept and wrote the book, which I thought was incredible, because it's difficult to write a book about life insurance and do it in a short book too, and explain it into such a palatable way that you could show someone how you could set up sort of your own little banking system and decentralize yourself from the Wall Street casino.
So guys, if you're out there listening right now and you want to get more information from MC and his team, you're going to email ninja@vipfinancialeducation.com. Again, that's ninja@vipfinancialeducation.com. Include your first, your last name, and your phone number, and someone from his team will respond and obviously walk it through to see if it's a good fit all the way around. What are you saying to people? So right now, there's some, inflation's kind of that hot button topic right now. People are looking at their retirement accounts. Are you seeing a big shift coming from that into something a little bit obviously more guaranteed like this, that's not going to fluctuate with, market changes and market trends?
Yes. So what happens in these vehicles with inflation is there's inflated returns, obviously, for the insurance companies, which is distributed to the shareholders, which is the policyholders. So it's one of those vehicles that is positioned for that. But one of the things that I think a lot of folks are looking at in times of uncertainty, and we saw this last year, in times of uncertainty, people are looking for things that are certain, things that are more predictable, things that provide more peace of mind, and things that they know is there. Because as investors and as business owners, sometimes, we're so focused on the investments or the things that, we get, massive returns on or acquire, or assets or rate of returns. But sometimes without a foundational basis, we leave ourselves exposed. So we saw a lot of folks, we worked with a lot of folks across the country in 2020 that was looking for that exact thing, where they said, MC, I've got investments, I have qualified retirement plans and so forth, but I feel that I'm still there. There's something that I need. I don't have that certainty yet. What can I do? And this is one of those things where you can put your money in there, it's there. You can access it when you need to, and that in the volatile environment that we're going in and already in, you've got something that you can bank on. We had someone that retired in 2020. this amazing couple. That's the year that they picked. They set up policies with us 2 years prior to retiring, but they called us and said, "What do we do? The market just plummeted 40%." This was last year, as you can remember, when the lockdown started and so forth. So there was a lot of chaos. Well, we shared with them and that they had these policies and they didn't have to draw money as they planned from their 401ks or their IRAs to live on that year. Just think about that. You have your retirement savings now, it falls 40%. Now you got to draw from that for a year to live. So now all of a sudden, how much do you need to earn just to get back to where you were, right? But because they have it, these policies set up, they could draw income from that. And then when the market came back, that now they've moved a lot of it into cash, repaid the loans, set up more policies, but it offered and provided them a volatility buffer. So in uncertain times, you want to have things in place that you can bank on, that you can utilize and leverage, because we are living in very interesting and uncertain times still.
Yeah, no, and I like how you kind of keep hitting back on just being prepared. There's nothing wrong with being wrong about being prepared. If those things that you are anticipating never happen, guess what? You're better off than you were before. But if you don't do any of those preparations, you don't have the foresight to really set that table for yourself. Obviously, if you're wrong about saying that those things are not going to happen, you can be put in a pretty tough spot pretty quickly. What would be, from a wealth standpoint and also from an age standpoint, what would that kind of demographic look like for someone that, might want to take a look at this, and that might be something that's, beneficial to them?
That's a great question. And to your earlier point, predicting rain isn't enough. You've got to build arcs, right? So markets do three things. They go up, down, and sideways. So you want to prepare for all outcomes and position yourself for different demographics and different folks at different stages of their journey. It provides a great opportunity in many different ways. So you've obviously got folks that are starting out that's younger. So they've got a lot of time. They don't have a ton of resources yet. They're still skilling up and increasing their ability to earn. There's strategies for them that they can implement and execute using this vehicle. Then there's folks in the middle that sort of already built up some resources and capital, folks in their late 30s, 40s, and 50s. There's different strategies for them too, in a way that you could set up these policies. And then there's folks that are in their 60s, 70s, and even 80s, believe it or not. There are strategies available for them. So retirement, for example, there are a lot of folks that looked at the tax liability of, for example, the United States government in the future, and they feel uncomfortable with a looming tax liability that's out there. I think, what are we up to? Almost $30 trillion. It's kind of crazy. But anyway, so what they're looking at is saying, I need more control. I need to put my money into a place where I could draw tax-free income from eventually. So they would figure out a strategy of how to liquidate retirement funds and positioning it into a policy like this. It's very powerful. It gives them certainty, security, and a tax-free income stream where a lot of folks will be worrying 10 to 15 years from now, well, what do I do? Taxes just went up exponentially to pay for all this money printing that's going on lately. That's a strategy. Another strategy is estate planning. Things are about to change big time from an estate planning perspective. And what I mean by that is currently in 2021, there are certain estate and gift exemptions. I believe it's 11.7 right now per person, 23.4 per couple. That's your estate and gift exemptions. Those are going to go down considerably. It was supposed to go down anyway, I believe, in 2026. So at that stage, they would have looked at to renew it again. But the current administration has already proposed that it goes down to 4.5 million per person, 9 per couple. That is massive. So what that means is, let's just say there's an estate that someone has that's over that amount. It'll be taxed. Currently, it's at 40%. The proposed tax is at 45%, which if you have some capital or some resources to pass on to future generations, it could really factor in. There's a lot of folks probably listening to this and say, well, I don't have that resources or I don't have that estate yet. You could potentially have that. That's one way. So you have to do proper estate and asset protection because folks listening to this channel are always trying to build a bigger and better future for themselves. So they most likely will get there. And then the other thing is also, if you are in a position, let's just say in your 70s or your 80s, there's strategies that you can gift up to $15,000 per year per grandchild and child and spouses of children and spouses of grandchildren. So there are certain tax strategies that you can implement and execute that way, and also fund policies through this for children and for grandchildren. So there's sort of a little ninja strategy on the back end to ensure that you're passing on your legacy to children and to grandchildren. And I would just say, definitely speak to an estate planning professional and or legal professional with regards to that, because there's a lot of moving pieces to it.
Now, who would it not be for? What stage in your life would it be? You know, what kind of minimum capital requirement would there be to get involved just to begin with from just the outset?
That's a great question. So I always say that we all start somewhere. I started somewhere too, where I didn't have resources. I was trying to skill up and learn. There's a build-up phase where you're just trying to build up skills and start paying yourself first. So someone that's in a process like that, you know, I always say when folks reach out to us, start by putting away 10% of your earnings. The richest man of Babylon, you know, is where that concept comes from. Pay yourself first. And someone that's in that stage, it's probably not a good fit for yet, because you want to develop those good habits and money habits and good set up good systems and processes. So I would say eventually, when you have put away 10% of your income at that stage, and let's just say you could put an additional $10,000 per year into something like this, then I would recommend you do it. Because up until then, what you want to do is develop good habits, pay yourself first, and invest in yourself to skill yourself up. And when you get to that level of skill that you're now increasing and you're putting away money, it's sort of snowballing, then that would be a good fit for you. Another person that it's not a good fit for, we all go through different things in our life. There might be someone that has a ton of debt that is sort of in a bad situation. That might not be a good fit at that particular point in time. That could be a good fit, let's just say, a couple of months later. Because the last thing that you want to do is you want to incorporate a strategy with slight leverage in a situation where there's already a little bit of things not in line, right? You're just going to amplify what you're doing with this. So if you don't have your ducks in a row, it's just going to amplify that not having your ducks in a row.
Right.
What I'm trying to say. So get your ducks in a row first, get positioned, start paying yourself first, get some good money habits in place, and then you set up one of these policies. And then even if you have debt, because you can use this to pay off debt. I know some folks are listening to this saying, MC, you could pay debt off with it, of course, but you want to have good money habits set up first. You want to have proper things systems and processes up first and your ducks in a row before you start attacking that. So that's what I would say for folks. And we're all are different parts in our journeys. I was there once first. At that stage, you just pay yourself first, you skill up, and you increase your ability to earn in the marketplace. And then eventually, when you're ready, then you set up one of those policies.
Got it. So guys, if you're out there listening right now and you want to get more information from MC and his team, you're going to email ninja@vipfinancialeducation.com. Again, that's ninja@vipfinancialeducation.com. Include your first, your last name, and your phone number, and someone from his team will respond and obviously walk it through to see if it's a good fit all the way around. This is potentially the greatest transfer of wealth in the history of the world. You know, being able to be on the right side of that and really capitalize on that with experts behind your back, we always feel is important. Do plenty of research on this guy. There's tons of information out there on him, and I couldn't find a bad thing on you, and I dug pretty hard. So I guess you've kept it pretty squeaky clean over the year and just have done great business, which I obviously applaud that. That's how we do business here. Those are the only people that we bring on this show. They are out doing right by people. They're doing the right things, and they're conducting good business. So guys, reach out to MC and his team. They'll be sure to get back with you promptly. Drop a like below, guys. If you're not a subscriber already, go ahead and subscribe and hit that bell notification that's going to give you alerts every time we've got new and great content on this to share. Thank you for joining us here today, MC. It's been a real pleasure. And all you guys out there watching, thanks for joining us. Until next time, take care.